right, hey guys, Kevin here. This is video lesson number 2, and this video lesson is continuing our conversation about calendar spreads, horizontal spreads, time spreads, however you want to refer to them as. But recapping video lesson number 1, a calendar spread is a neutral trade. It can be constructed as a bullish trade. It can be constructed as a bearish trade. It is created by selling front month options and purchasing back month options as protection. That distance that separates the two will determine your slope of your T plus 0 line, as well as how expensive or inexpensive your calendar is. So what I want to do for this video lesson is 2 things. I want to set up a calendar trade, and I just want to talk you through some basic guidelines and some basic management ideas, and then I want to walk through one underlying vehicle, the SPY. This is what I recommend all brand new traders to start with. The reasons are: it's very liquid, it has very tight bid-ask spreads, there is tons of liquidity and open interest, there's lots of volume, there is very little slippage. The drawback to that is it will be commission intensive, meaning if you are spending $1 per option contract to enter and exit a trade, you will spend the bulk of your profits on commissions trading the SPY. Now, that is important in the beginning because you're not trying to make money in the beginning. You're trying to not lose money, and you're trying to understand processes and mechanics and how options actually function. But you will not stay in SPY forever, and you certainly do not want to. I would not want you to try and start out with something that has a very large bid-ask spread, and you're so focused on saving money on commissions that you miss the benefits and the opportunities with trading one strategy, in this example, the calendar. So we'll start with the SPY. I am going to show you a setup and a construction, and this will be based upon this right here, this calendar, these calendar trade guidelines that we have talked about in the forums, and we will just walk through a very simple, methodical, structured way to trade a calendar and watch how it performs. Okay, I have no idea what the end results are going to be, but I do want to show you my process when I go through how I test, to show you what to expect when trading a calendar. Okay, so again, we are selling 1 month, we are purchasing the second month. If we want to go 1 month separation, meaning we're just staying in the monthly expiration cycles for this video lesson. These options here, this one expires the 3rd Friday of the month, this one expires the 3rd Friday of the month. Your shorts will expire before your longs. However, this is your profile. So at expiration, 26 days from now, if SPY has moved nowhere and it stays right at 207.98, your profits will be approximately $140. Okay? It's a $135 risk trade. If you separate and place the long strike farther out in time, it's going to be a much more expensive trade. It will give you a little different risk profile. You will have less potential profit. You still have the same amount of days to expiration for your short strikes, but the long option you are purchasing as your protection is $1 more expensive than in this expiration cycle. Okay, so that's very important to stay in check with when starting out, because keeping one expiration cycle in between these two will help keep that risk as low as possible. as well as keep that spread on your side. Okay, so we could sell this one in 54 days, buy this one at 82 days. Our net margin is even less, and I hope you understand the reason for that is because we are generating much more credit on this option than we were when we sold this option. So the difference between selling 271, buying 406 is greater than the difference between selling 406, buying 506. You still get a calendar profile, but now you are risking 100 to potentially make 175. Now, that doesn't change anything about how a calendar operates. A calendar still is a delta neutral, risk defined trade, right? It's sensitive to these changes in volatility, but going further out in time just keeps this T plus 0 line a little bit flatter. And when that T plus 0 line is a little bit flatter, what I want you to notice is you can weather a larger move before you experience larger losses. If I am in this particular trade, I have 54 days to expiration. I do not advocate, nor do I ever try and target the maximum profit, because you're never going to achieve it. I always select a type of percentage based upon margin. So if I'm risking $100, well, I'd like to target maybe 10 or 15% of that. Some traders may want to target 20%. You may want to target 30%. You may want to target 50%. That is up to you, but I would advise and strongly recommend start with a very small target when you're starting out. Risking 10% of margin to make 10% of margin, or something along those lines, okay? So that way you can get your feet wet, you can begin trading calendars, and realize that you don't have to risk a ton of money to trade these. And the more you trade them and the longer you trade them, the more confidence you develop around them. If I came much closer, much higher risk, well, now, please notice this T plus 0 line has got a much greater slope to it, and my risk is now basically risking one to make one. Doesn't change my assumptions if I am targeting 10% of margin and I'm willing to risk 10% of margin. All right, well, the monetary amount is still the same. And let's have a quick conversation about that. Let's not trade P&L. I don't want you guys to look at your profit and your loss. I want you to trade the process. And the P&L is just a way to measure and to calculate and determine if you're following your process. Your process should be, I am attempting to trade a delta neutral strategy, which is what this calendar trade is. All right, one variation. I'm trading a delta neutral strategy, and I am willing to risk a certain amount in order to make a certain amount. And what I want you to focus more on is how these decay and how these options are sensitive to changes in volatility. That's what is so relevant and so super important right now. It's no different than if you were going to buy and sell a pair of tennis shoes. And if those tennis shoes, if the price changed based upon what the current demand was in the market, well, that, if you can think of that or imagine that as being the volatility, well, the price of those pair of tennis shoes is going to change depending upon market sentiment, right? If there's a bigger demand for these particular Michael Jordan, limited edition type shoes, well, the price is going to change depending upon how much supplier demand there is on those. It's no different with options. And if you can just imagine this volatility as what changes the price, When volatility changes, price changes. Okay, that's it, pure and simple. So let's walk through, let me walk through 3 different scenarios in this video lesson. Okay, I want to walk through a delta neutral scenario and show you one way to manage it. I want to walk you through a bullish trade scenario, show you one way to manage it. And we'll walk you through a bearish trade scenario, show you another way to manage it. Because the markets do this all the time. And let me back out just a little bit here. If we look at this is the market on the weekly time frame. All right, lots of boxing, a little bit of breakout right here, boxing. We've got boxing, we've got boxing, we've got boxing, boxing. If I bring that in even to the daytime chart, you can see that a lot better, right? So if we are saying this is what a market usually does, or this is what a market typically does, it breaks out of a range, it finds a little range. It breaks out, maybe it finds a big range. Or it finds a much larger range and then it has a massive breakout, but it still returns to that area of boxing. Still returns that area of boxing. Still returns that area of boxing. Now, you can see it on even a smaller time frame and horizon, but if we are attempting to layer, and this just gave me a really good idea for a video. If we are attempting to layer multiple approaches, meaning there is no reason why I cannot trade a delta neutral, a bullish, and a bearish, and they are all 3 managed separately, but with very specific risk parameters inside of each one, there's no reason why we can't trade every single market condition, right? If you are following your risk and your trade management. So one of the later videos, I'll do that. I'll show you a way to trade 3 completely separate different approaches inside the same market, and you're managing all 3 of those differently, and you're not expecting all 3 of them to win. But what you are expecting is to keep your risk in check and respect your risk management. Okay? Now, let's go back in here in time. I would like to say today is April 25th, 2016. All right, so I'm recording this on today's date. Here's what the market's doing. I want to go back, and we will say, let's go back to the beginning of 2015. And we'll just go back here. Here's January 2015. We started out, kind of jumping around a lot. We broke out. We hit all-time highs in 2015. We had a pretty much an extended year of trading sideways, and let's go back in that time frame and show you how a calendar operates. And this is specifically going to be on the SPY. All right, it's going to follow the guidelines that I have posted right here. All right, it's going to follow these guidelines. Whatever the amount is, I'll enter, anywhere from 20 to 40 days. If we have lower volatility, I'll enter closer. Higher, I'll enter farther. And I will keep the short strike pretty much right at the money, or a little bearish, a little bullish. Place the long strike the next month out. All right. And we'll just target 10% of margin, and I will make the max loss 2 times of that. And the reason why I do that, and again, this is just very individualized. I know just through my experience and the way I have traded calendars, if you manage them accordingly, they will win more than 50% of the time. They will. And so if you are keeping that risk in check and you are saying, well, if I'm willing to risk 1 to make 1, or I'm willing to risk 2 to make 1, I need to make sure that my edge is greater, so my strike rate is so much that I will win at the end of the year. So my net profits, either at the end of a month, end of a quarter, end of a year, end of a decade, whatever your time horizon is profitable. So let's make that the approach. I'll start out here, and I will just go through. I'm going to construct a trade. I will benefit from waiting until an increase in volatility, and that will happen on a down day. But I am going to say, for testing purposes, this is all I'm going to do. I'm not going to watch what the market is doing. I'm going to go in the market at the end of the day on a Wednesday, and if I am anywhere from 20 to 60 days to expiration, that's going to be my short strike. All right? So I'm going to say, well, here's 45 days on this one. Here's 73 days on this one. I'm going to come right at the money, and I'm going to say I'm going to sell one and I'm going to buy one. That's it. I'm going to convert that trade and say, okay, I have sold one option that expires in 45 days for $4.38. I have bought a second option that expires in 73 days for $6.06. The most I can ever lose on this trade is $168. I am at delta negative. I am theta positive. This becomes relative to the size of the underlying and the number of contracts, and this will become much more noticeable in subsequent videos when I trade different equities, or I show you an SPX or the Russell or NDX, different types of underlying vehicles and the challenges that those present. So right off the bat, you'll notice this is the trade, right? We have defined risk. We have much more risk to the upside, right? We have still limited risk to the downside. Our volatility on the front month is greater than the back month. This is what, if you're prone to taking notes, if you're a note taker and you're jotting notes down, this is important to jot down. When you are trading calendars, the front month volatility should equal or be greater than the back month volatility. And I'll say it again. When trading calendars, it's important and ideal to have the front month volatility greater, equal to, or greater than the back month volatility. All right? And the reason for that is this decay occurs not only on the time decay aspect, but also on a volatility. As we get closer and closer and closer to expiration, the volatility is a lot more sensitive at the money, but eventually it's going to zero when these expire. So changes in this volatility, if we are selling a high volatility, remember we talked about this in the first video, if we are selling a higher volatility, we benefit when that implied volatility level drops. It is going to drop more quickly. It's going to be more responsive. Let me say that. It's going to be more responsive to the shorter termed options than the longer termed options, meaning this is going to drop quicker than this one will. Conversely, this will also increase quicker than this one will. So if this is a trade construct, I'm saying I know my defined risk. I'd like to say, just for simplicity's sake, just for numbers' sake, I want to risk 20 to make 20. I'm not worried about my P&L. If $168 is going to cause you a lot of life stressors, then maybe trading options is not for you. And I'm not, please, I mean that in the kindest, most respectful way possible, but we are talking about risk in the markets. You have to accept that risk. You are trading with money that is not going to change your lifestyle one bit. You have not, taken out a loan. You've not borrowed money. You have not. This is not money. This is money that you can afford to lose. You don't want to lose it. I don't want to lose it. This is money you can afford to lose, and it will not change your lifestyle one bit. Okay? So let's get that right out there, right in the open. We're not trading P&L. We're trading processes. Process here is I am wanting to trade this as it gets closer to expiration. Keep my delta in check. Watch how the theta increases, and any kind of increase in volatility I can benefit in a short period of time. So that's the trade. All right. So we'll go forward a couple of days and we'll watch how this reacts. And that is one unfortunate thing about option view. It does take it a couple of minutes to update, and it does take it a few minutes to kind of catch up. So I sold it for 438. I buy it back for 351. I paid 606. I buy it back for 517. It's pretty much an equal decay at this point, right? I mean, market really didn't do anything over the next couple of days. It gapped up and then it traded down. Please accept the fact that this is a non-directional approach to trading the markets. This is a risk management approach to trading the markets. I am not putting any weight whatsoever into this price chart. I am not looking at it looking for swing failure patterns. I'm not looking for bearish outside engulfing bars. I'm not looking for pin bars. I'm not looking for fib retracements. I'm not looking at anything on this price chart. I am purely monitoring how these options decay. That's all I'm doing. And as long as these options stay within a predetermined range, that range is between 194 and 211. Between 194 and 211, I pretty much keep my hands off and I watch what occurs. We didn't hit between 194 and 211 in the last few days, so I keep going. Let me go forward we'll say a whole nother week. And I'll look back and see if we hit either one of those ranges. Probably the biggest attractor to options is the ability to not have to watch the markets intraday or stay chained to a computer throughout the market being open. You can look at these positions at the end of the day, at the beginning of the day, once throughout the day. We didn't hit 194, we didn't hit 211. We keep going forward. And as we get closer and closer to expiration, please notice these options are losing their value. So are these that expire much more time. These lose their value quicker. And there's a whole video lesson in the tutorials about why that is, the option decay curve. Please watch that so if that doesn't make sense to you. We haven't moved anywhere. We've more than hit our target profit. My recommendation when you are starting out is to close the trade. If you have hit your target profit, it is foolish for you to hold it open and say, well, let's just see what happens. Because when you say let's just see what happens, what just happens is more often than not, you let a winner become a loser. Okay? And what I just did there is I changed one of the settings from variable 1 day, meaning it uses these calculations, not those. It uses, where are we at here? These calculations in here, all right, on my vertical skews. It uses the implied volatilities. It uses these variable models, and it changed it to every individual option on its own. And that matches and that mirrors Thinkorswim settings a lot more closely. Okay? One thing that I want you to notice, again, maybe we won't get to the directional bullish and bearish in this video lesson because I'm not going to rush these videos. And that's why I said at the very beginning, there might be 5 videos, there might be 20 videos, there might be 10, there might be 3 hours, it might be 10 hours. I'm going to make sure that as thoughts come up, I mean, I've got a bulleted plan that I'm following, but as additional thoughts come up, I want to make sure that I don't rush through and maybe miss something. But what I want you to notice is volatility on these increased. Remember, it was at 16 when we started. Well, now it's 18. So what we sold for 438, we're having to buy back at an elevated price for 471. But where we're making our profits is the ones that we purchased for 606. Those also increased in volatility. Granted, the percentage and the ratio is not as much as these, but we still offset, because these are higher priced options, more time to expiration, the profit on these offset the loss on these. Okay, so I hope that's very apparent and very key, and you understand that. So we'll just say we would close this and we would close that, we would sell that, we would buy one, and we'd convert the trade. So that trade is done and it's a winner. Now, what do we do? Do we just go ahead and open the same day a new trade? Yeah, why not? It's a different expiration cycle, right? And if we're saying we're opening them on Wednesdays, why wait? Why wait another Wednesday? If you begin, and this is another thing. Yeah, these thoughts just come into my mind at all points in times. You'll get used to it, I'm sorry. But this is another thing that traders do is they say, well, you know what? I'm going to time changes in volatility or changes in the market, or I don't want to be in the market all the time. No, nobody does, but if you're flat and you have an opportunity to get in the market, well, who's going to decide when's a better time than another to execute a trade? Well, nobody knows. So if nobody knows, you can either choose to be in the market all the time in one capacity or another, or you can choose to be out of the market and only pop in and pop out on very specific select circumstances that you have identified you want to be in. For me personally, if I am flat and I just have closed a profitable winning trade and I have a 2-point move down in the SPY that looks like this, and I am benefiting from a pretty big increase in volatility, well, what did I say at the beginning? As long as the implied volatility on the front month is equal to or greater than the back month, I have no qualms about opening another trade. None whatsoever. I would go into my trade log and I would say, all right, my February-March trade is reconciled. It's over. Now my March-April trade has begun. And if this number, if this implied volatility is ever less than the back month, you still have the potential to be profitable. It just makes it much more difficult, much more challenging. We always want this front month to be the same or greater than the back month. All right? So now, this particular trade's cost me $121. Volatility is higher than it was when I started the other trade, right? Start that other trade back in here. Implied volatility is higher than when we started the other trade. We have more time on the front months and the back months. That's reflective in the cost. And this is our risk profile. So we say, all right, it's a $120 trade. Let's use the same construct. I want to risk 20 to make 40. Or I'm sorry, I want to risk 40 to make 20. 2 to 1. Well, I don't really, if this is my T plus 0 line, I don't get down to losing $40 till I'm way outside of my tent, both sides, and per some guidelines that I've posted in the forums, right? These forum guidelines right here for a calendar trade, I'm going to adjust it when I'm halfway to break even or even at break even. So I will begin considering an adjustment at about this 195 or we'll say 207 level when I'm essentially down a couple of dollars. So we'll say 195 to 205. How's that? So take this off. So from 195 to 205, and odds are 205 is going to get hit before 195 will, but we don't know. Maybe 195 gets hit the very next day. But you have to have that in place at the beginning so that when you go forward in time and you are watching a trade develop and mature, if you hit either one of those levels, you know in advance I'm either going to close it, take my loss, and just wait for the next one, or I'm going to add capital and continue trading it. Well, now what do we do? All right, so we need to go back and we need to look. We did hit 205 on the 3rd. So we need to go back to that day and see what did that do to our trade on the 3rd. And yes, again, it does take it a minute to update. I apologize. So we hit that area on the third, and we're down nothing. We're essentially at break even. So that's when you decide I either close my trade because it hit 205 like I said it would. So in the beginning, that's what I say to do. Close it, open another trade. Okay? You're out some commissions. You have not lost $20 or even $40. You've lost some commissions. Big deal. Or I say, well, I am at a adjustment point. I'm at a decision point. I like to refer to these as decision points. I have a decision to make. I can either A, add another trade on, which takes an existing trade like this, it adds a new trade like this, and when both of them are combined, it gives you this. And you can say, well, I have added more margin, I have added more risk, I've also added more potential profit. And if you are prepared for that, you are still maintaining a delta neutral approach. But again, you have to say, I have changed the whole construct and the whole setup of a single calendar. I've now made it a double calendar. So where, if this has occurred, where are my new adjustment points? Do I let it go all the way back down here and jeopardize losing even more? You know, in the beginning, I was able to let it go way outside of my break even and be only down $40. I let that happen now. If I get to 195, I'm down $60 or $70. I've hit 205. Where do I let it go on the upside? 210, 215, 220. I mean, what's your plan? So if this was the decision point, well, then you say, all right, once I get to this expiration break even, 210, I close the whole trade down. I do not keep chasing a trade, throwing new money after old money. I put new money in a new position. Or if I get all the way down here to 196, 196 is my original maximum loss, or $42 was my original maximum loss when I was targeting 20. So I say, all right, I will let this range and roam between 196 and 210. On a price chart, what does that look like? Between 196 and 210. All right. Well, that looks to me like that covers a pretty wide area range in which to target. I mean, my original margin was 120. Now it's at 247. So if I convert that, I have to make sure and reconcile it the same variable so that I'm keeping the trade the same. I'm not down any money. I'm still delta neutral. My theta is still positive. So let's 196 to 210. We'll go forward into the middle of the next week. Being aware of the fact that these are going to be now 1 week closer to expiring, right? 38 days. And now my $3 is now $26. I hit my target profit. Did price ever hit 196? Did it ever hit 210? No. I had to keep my fingers off the mouse and let theta decay. And this is the trade. We are approaching the 210 level, right? And this is what trips up traders sometimes and gets options traders into trouble. You get greedy, and I mean, I'll be the first to admit it. I've done it, and it's something you have to be vigilant and be constantly aware of. But if you hit your target profit, close your trade. Accumulate your profits slowly over time, build your confidence, and grow your account size. But traders will say, well, man, yeah, I'm up $26, but look at how much is still in there. I mean, there's $200 in there. All it has to do is move down a little bit and then move up a little bit and move down a little bit and move up a little bit. All right? You put yourself right back in that camp of trying to force the market to do something you want it to do instead of reacting and responding to what the market does. The market's going to do what the market's going to do. If you are up profits and you've hit your target profits, this is 10% on margin, right? not counting commissions. Commissions become relevant when you're trading larger accounts and larger underlyings, right? But you've hit your target profit, close your trade. So we would say, all right, we close our trade. I'm going to leave this open intentionally just to show you what can happen sometimes. We'll go forward another week, right? I don't know if it goes up. I don't know if it goes down. I mean, I don't remember the beginning of last year. I know it chopped around a lot, makes it ideal for calendar trades, makes it ideal for butterflies, makes it ideal for condors. But now your 26 has now become 8. All right, and we continue driving on up. We hit the 210 level. So I want to ask you a question. You had your target profit. You chose to not close it. Now you're back to break even. How do you feel right now? How does that make you feel? And I mean that in all sincerity. How does that make you feel? If you're like 99.9% of the majority of traders, that's annoyed you and that's pissed you off. It's like you've given up your profit. The only thing greater than that is the fear of missing out. Everybody else is making money and you are not. All right? That's the only bigger emotional connection to trading. So if you have now let your winning, profitable, take profit trade become break even, you have just put yourself in a very dangerous position to start chasing a trade, throwing more money, and or letting it roam all the way out here and incurring much greater of a loss than what you were prepared to do. Okay? The flip side to that thought is if at the beginning you position size accordingly so that $250 is nothing to your account size. It's, a half of 1% or a tenth of 1% or whatever account size you have. And you have chosen to say, well, you know what? I'm going to let this go all the way to expiration. And I'm either going to lose 247 or I'm going to make anywhere from 0 to, what's the peak in here? 278, 285. If it closes at expiration between 195 and 209, then I will just be content and keep those profits. Otherwise, I'm going to let this go all the way to expiration. That is another valid trade management approach. And I know traders all the time that do this because what happens? Price ranges, it breaks out, it comes back in a range. It boxes, it breaks out, it comes back in a box. And what I want to show you is those two different styles of approach. You really have to experiment and determine what's going to work the best for you. For me personally, if I hit a target profit and I've identified, you know what, I want to make 10% on margin. When I hit that, I close it. And I don't think twice about it. I don't look at the potentials. But if I have trades that I say, well, I'm willing to absorb a 100% maximum loss on this, and that just happens to be $247, all right, well, hands off. I'm not touching it. I'll wait until we get closer to expiration and I'll see what occurs. So used to have 31 days expiration. Let's go forward 1, 2, 3, 4 weeks. So that's going to put you just a handful of days before expiration. Remember, you had your target profit and you chose not to close. You chose not to keep it. So now what do we have here by letting it stay right there? What did it do? It closes way outside of here. There's 3 days to expiration. What did the price do at any one point in time? We can go right back here to this peak on the 11th. We can go a week prior, and we can say the week before expiration, this trade was worth what? Much more than the $26, right? $103. Because we are right in that sweet spot of that range between 196 and 208. And that's the expiration break-evens. Again, guys, this is sometimes what makes options more daunting and more overwhelming, is there are additional choices that you have to make and additional decisions. It's no longer did my stop loss get hit, or did my take profit, or am I trailing my stop? If I'm a directional trader, it's cut and dried, right? I'm not trading that additional time element. With options, you are trading that time element, and that's the decay factor in how these options decay. But it doesn't change the money management side of things at all. It just changes your approach, and your approach is either hitting target profit, closing your trade, or accepting the full risk on the trade that you have. But you still have to make that decision when you're going to close your trade. When you're up 10%, 20%, 50%, 100% loss for 100% gain. I mean, these are choices you have to make. I am just introducing you and showing you to what's possible and how I trade the options in such a manner to give you the safest, most simplest manner in which to accumulate profits. All right, so I'm going to go ahead and start wrapping this up. We're at about 42 minutes right now, so I didn't think it would go this long, but you know what? That's okay, and I'm not going to rush it. I'm not going to force my thoughts into a spreadsheet or a bullet pointed document. As my thoughts evolve and as I come up with things that come into my mind, I'm going to just be kind of receptive to that and share with you guys my thoughts. But I'm thinking that you're probably going to end up getting about 8 to 10 hours of video content with this course at this pace, and that's good because it will be very comprehensive, and I think you will find a lot of value in it. So guys, thanks much. This concludes video lesson number 2, and we will have video lesson 3 coming up next, where I think what I'll talk about is structuring these with a directional bias, meaning either a bullish or bearish bias, and we'll just walk through a couple of different examples on that. All right, thanks guys.